day. Welcome to the Chartered Accountants Academy video lecture. My name is Mutsawashe Mbaiwa. I'm a lecturer in the Management Accounting and Finance Department, and today I'm going to be covering with you Performance Evaluation Part 2. So my assumption is you've gone through Performance Evaluation Part 1. Now let's discuss our learning objectives. So we have one major learning objective, which is to understand economic value added, which I'm going to be calling EVA, and to understand EVA adjustments and how it links to net present value. Now let's get right into it. Economic value added. What is economic value added? So economic value added, it is a financial measure measuring the return earned by a firm that is in excess of the amount that the company needs to earn to appease its shareholders. So what does performance EVA do? So EVA compares the rate of return on invested capital with the opportunity cost of investing yields elsewhere. So the idea is that value is created when the return on the firm's economic capital employed exceeds the cost of that capital. So this is important for businesses to keep track of, particularly those businesses that are capital intensive. So when calculating economic value added, a positive outcome means the company is creating value with its capital investments. And conversely, a negative outcome would mean that the company is destroying value with its capital investments, and the capital would be better spent elsewhere. So businesses can use EVA to assess managerial performance, as it serves as a measure of value creation for shareholders. Now let's discuss the objective of EVA. So EVA aims to convert accounting profit to economic profit and to give the return taking into account the true cost of financing activities. So in other words, EVA wants to get to cash flows to be as close to as economic cash flows as possible. So how do we achieve this? So we need to exclude any costs related to long-term financing to prevent double counting. So items are either deducted from the profit or deducted in WACC. So if an item was deducted from the profit, you cannot deduct it again from the WACC, so items cannot be deducted twice to prevent double counting. So we need to consider what has been included in profit as the starting point. Now let's go into the formula. As we discussed earlier, EVA wants to measure value that is created from the capital that has been invested from the project, and what return in the form of profits are we getting. So the formula is our operating income after tax plus or minus adjustments, which are accounting adjustments, less my WACC multiplied by total assets less current liabilities. So the total assets less current liabilities speaks to investment side. So we covered what assets to include under investment when we talked about return on investment in part 1 of performance evaluation lecture. So we are not going to be focusing on the total assets less current liabilities section or on the WACC section, but rather we'll be focusing on the operating income after tax plus or minus adjustments. What items should we include, and how will they impact on the profit that we currently have? So key principles when adjusting profit are: we need to reverse accounting entries and account for economic substance. So we need to replace accounting depreciation with economic depreciation, which reflects the economic usage of an asset. Number two, we need to reverse once-off items that are not sustainable and would distort long-term profit. So for your once-off items, say you decide to sell an asset that is lying idle, that forms an example of a once-off item, and it is not sustainable as you are not going to be selling assets on a regular basis. So if we include such a sale, it is going to distort our long-term profit. Lastly, we need to reverse non-cash entries. For example, your deferred tax, as you want to be as close to cash flow as possible. Now let's discuss on accounting adjustments. First of all, we need to adjust for amounts that are expensed under IFRS that have enduring benefits. So examples of amounts that are expensed under IFRS were, for example, advertising costs, research and development, and intangible assets that do not meet the recognition criteria. So for such expenses, they might be expensed under IFRS but actually have enduring benefits. For example, I'm going to pay the advertising costs now, but I'm going to enjoy the benefits of the advertising or from the research and development over a period of 4 years. So I need to adjust for such expenses. Now, how do I adjust? So the income and expenses are adjusted for these amounts. So if you were to provide journal entries, the transaction affected the income, it also affected the assets. So these were adjusted when we paid for the advertising. So what do we need to do? We need to add back the expense to income, and then we capitalize to the asset and amortize over a period of benefit. So I add back my advertising income, I capitalize the advertising cost as an asset, which I'm going to amortize over the period of benefit. Number two, we need to adjust for purely accounting entries, that is no physical cash flows. For example, your depreciation, your amortization, even your deferred tax and your provisions. For example, your provisions for credit losses, your provision for doubtful debts. So for those items, we need to add back to income to reverse the accounting. And if information is provided as to how the real economic value of an asset is declined during the year due to utilization, this amount should be removed from income as economic depreciation. So we need to deduct this economic depreciation. As highlighted earlier, we need to adjust for accounting cash flows and rather reflect economic usage. So if information of the economic usage has been provided, we deduct the economic depreciation from income. And for profits and losses on sale of unusual items not normally sold by the business, that is what we call once-off items, which we discussed is not sustainable and would distort the long-term profits of the business. So how do we adjust for this? So we have your profit or loss on sale of property, assuming not usual. So these profits and losses are not an indication of sustainable earnings. They are once-off and therefore should be removed as they may inflate or deflate the real performance of the manager. So what do we need to do? On the income side, where we are talking, how did it affect the operating income? So for a profit, it increased the income, so we need to deduct profit on sale of property. But if it was a loss, it was an expense, so we need to add back to income to reverse the accounting, and then the asset that was sold, we need to add back that asset to the total assets, so that we go back to a position where we were before we sold the property. Now let's discuss the advantages and disadvantages of economic value added. So for economic value added, the operating income limits manipulation. So the accounting adjustments that we just discussed previously remove IFRS distortions and provide economic profit. This removes the element of manipulation, that is, those accounting adjustments that is the way normally manipulation might happen. So by us adjusting for those accounting adjustments, it removes those distortions and provides economic profit. And it takes into account, why? Because it is actually a cash flow that has been incurred by the entity, and is highlighted. Our objective is to get to as close to economic cash flows as possible. So since tax is an actual adjustment, we would need to take it into account. The other advantage is that it properly calculates the result that we get, that is the EVA, is calculated hinged on WACC. So based on that, it takes gearing into account, that is how the entity's capital structure, is, and it allows for different risk levels to be taken into account through use of different costs of capital. So the WACC consolidates different cost of capital, allowing us to factor in these different risk levels should be as we are operating. And the other advantage is the working capital management is rewarded. So this means if I'm to manage my working capital properly, I'm going to be rewarded. How am I rewarded? On the investment side, when we talk about less total assets, less current liabilities, that's where the working capital management starts to kick in. Based on we are picking up discussion that we had from performance evaluation part 1. We are now saying, if for example, if my creditors want me to pay them back in 3 months, and then I ask for my debtors to pay back within a month, I have 2 months worth of cash which I can use to finance other activities of the business, which is helping or linking to rewarding of working capital management. It is an economic measure, it's an advantage. It is based on MPV principles, that is the adjusting of cash flows so that we have real cash flows. So, and it is moving towards cash basis rather than accounting basis. So that gives us an added advantage when we are of using EVA. The other disadvantage of EVA is that it is an absolute measure. So therefore, since it is not a performance, not a percentage, we cannot compare our EVA across different investments. So EVA of company A cannot be compared to EVA of company B due to differences in size of investments that company A invested versus what company B invested. So to compare the issue with regarding to size, we should compare, the EVA should be compared to budgets or to targets to reflect on size. And the other disadvantage is there are complexities involved in the calculation. As highlighted, we need my operating income after tax plus or minus adjustments. I'll need to calculate my weighted average cost of capital, and I'll need my investment, which is sums up the complexities in the calculation involved. Now let's link back our EVA and our net present value. So since the net present value maximizes shareholder value and the present value of the EVA is equal to the net present value, EVA should also maximize shareholder value. So the present value of EVA is equal to NPV, and since NPV maximizes shareholder value, EVA should also maximize shareholder value. So sometimes if an annual EVA is viewed in isolation, it might result in an incorrect decision being taken in 1 year, where a straight line economic depreciation is used. So this can be prevented by evaluating managers over the long term or including financial measures. So the NPV should result in the same decision being made as EVA is trying to get back to cash flow principles. Hence, that's why we are saying the present value of EVA is equal to net present value, as we are trying to get back to cash flow principles. So NPV is a tool used to evaluate multiple year projects, while EVA is usually used to evaluate a manager or divisional performance on an annual basis. So the discounted EVAs for say a 5-year project should give you the same result as an NPV for the same project. As I highlighted earlier, sometimes if an annual EVA is viewed in isolation, it might result in an incorrect decision being made. So to avoid this, we need to evaluate our managers over the long term or including non-financial measures when we are evaluating the managers. Another concept that comes through, linking economic value added and market value added. So EVA is a performance measurement, and MVA, which is market value added, is a long-term wealth measure that measures whether a company has increased value over time. So as also our EVA wants to measure value that is obtained if we invest a certain amount of capital in a project or in a division or in an entity. So as a company performs well, it will retain earnings and shareholders will be paid a higher premium as a result of the past performance. So if it is positive, management actions and investments. If it is negative, the management's actions and investments are less than the capital contributed and wealth is being destroyed. If it is positive, management's actions and investments are more than the capital contributed and wealth has been created. Linking the economic value added and market value added. So from this lecture slide or from this lecture, the next step is to go through part 3 of this lecture recording. So our next step is performance evaluation part 3. So thank you. See you in part 3 of performance evaluation.